Hello, my name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. In today's video, I'll be discussing what has taken place since my last video and its impact on natural gas pricing. In my October 11th Energy Update, I explained why mild weather forecasted by NOAA for the end of October could present hedges with an excellent hedging opportunity before the winter heating season. And as you can see in this chart, natural gas appears to be starting its decline into what I believe will be an important fall low, and your last opportunity to secure hedges before natural gas likely rallies to a new yearly high in December. In today's report, I'll explain why, based on past hedging patterns, we may experience one of three scenarios. First, the window of opportunity for entering hedges prior to natural gas making a new yearly high in December may be about to close. Second, if we make a new yearly high in December and then experience a warmer than normal winter, the December highs will likely be the highest pricing experienced through the first quarter of 2022. But if we do experience a new yearly high in December and then experience a colder than normal winter, the December highs will be followed by much higher pricing in the first quarter of 2022. Pre-winter hedging patterns form based on risk anticipated in the winter heating season. In my October 11th Energy Update, I pointed out that since 2000, there were 4 years similar to this year. In 2000, 2002, 2005, and 2013, natural gas rallied into the fall from lower pricing, and in each case, pricing pulled back prior to rallying into a new high in December. As I wrote in my last report, Europe is entering the winter heating season with their natural gas inventories at very low levels, and the market has factored in the risk that pricing could skyrocket this winter if we do have a colder than normal winter, which is why natural gas did rally into October. But it's too early to know for sure whether we're going to have a cold winter or a warm winter. Therefore, a pullback near the end of October was not surprising. But after reaching its fall low, as we move closer to the winter, hedges will likely re-enter and push the market to a new high in December. And based on what took place in 2000, 2002, and 2005, and 2013, the fall low will likely occur in the first half of November before rallying to new highs in December. And the direction of pricing thereafter will be determined by the severity of this year's winter. And there likely will be two scenarios depending on whether we experience a warmer or colder than normal winter. As you can see, in 2000, after reaching its fall low on October 31st, natural gas rallied to a much higher yearly high in December. But the winter of 2000-2001 was milder than normal, and prices declined into the first quarter of 2001. In 2005, we have a second example of the mild winter scenario. After reaching its fall low on November 7th, natural gas rallied to a slightly higher high in December, but similar to 2000-2001, the winter of 2005 and 6 was milder than normal, and the prices declined into the first quarter of 2001. But we have a very different scenario when we experience a colder than normal winter. In 2002, after reaching its fall low on November 13th, natural gas rallied to a much higher yearly high in December. But then the winter of 2002-2003 was colder than normal, and the prices skyrocketed in the first quarter of 2003. And also in 2013, we now have a second example of the cold winter scenario. After reaching its fall low on November 5th, natural gas rallied to a much higher yearly high in December. And if you remember, the winter of 2013-14 was colder than normal due to a polar vortex, and the pricing skyrocketed in the first quarter of 2014. Therefore, based on these four charts, what may happen this year? In the four charts you just saw, the fall lows will all reach between October 31st and November 13th. Therefore, I believe we may reach an important low in the first half of November. And if we do, it could be your last opportunity to secure hedges prior to pricing going much higher to a new yearly high in December. No one knows for sure whether we'll experience a mild or cold winter this year. But based on what has happened in the past, if we do experience a colder than normal winter this year, natural gas prices above $10 are not only possible but likely. Therefore, if you delayed securing hedging, hoping for lower pricing, I hope this report helps you appreciate the wisdom of protecting yourself against the likelihood of higher pricing, not only in the near term, but most importantly, long term. Remember, as I wrote in previous reports, this year's rally was primarily due to Joe Biden's administration's restrictive energy policies and fear of inflation in the United States, along with a 10-year low in Europe's natural gas supplies caused by their green energy policies. And as I stated before, my concern is the policies leading to today's high pricing are not abating. They are becoming more entrenched here and abroad. No one knows for sure where natural gas pricing and electricity pricing will be over the next 6 months, but I firmly believe, as I stated in my most recent reports, 3 years from now, you may look back and realize there was only one cost of doing business you could have stopped increasing: your cost of energy for natural gas and electricity. Hopefully today's video helps you understand how to protect yourself against the risk of higher energy prices, and until my next report, please take care.